Yo, what is going on? It is Maleki, the growth and dividend growth investor. Just like the title said, somebody paid me $29,000 to hold on to Tesla stock. The way I was able to do this is through an options investing strategy called covered calls. This is one of the safest options investing strategies you can do to produce income. So pretty much the first thing you need to do a covered call is you need to own 100 shares of a company. That is the first and most important thing that you need to know. And ideally, this company that you are investing in is a company that has high growth potential in the next 10 years. So that's one of the most important things about this strategy. The second thing you need to know is that in the options investing world, 100 shares only equals one contract. So if you have 100 shares and you wanted to sell a contract, that would only be one contract and not 100 contracts. So without further ado, let's kind of look at what the thought process was, what my thought process was associated investing in this. So pretty much, I just want to show you the proof that I actually did get paid $29,000 to do this strategy. So if you look into my Fidelity account, I own 300 shares of Tesla, 200 of which I own outright, 100 shares I have in margin. And we'll talk about that in a second. But of the 200 shares that I personally own outright, I want to hold on to these shares. I never want to get rid of those Tesla shares because those are the shares that I paid outright with my own money. And those are the ones I want to keep for the next 10 years. Just because I believe Tesla is going to change the world and I believe that they're going to be a money printing machine. So I definitely want to hang on to them. So my thought process beside to make this trade happen was that if you look here, I owe $53,000 in margin. A couple weeks ago, I borrowed $88,000 to invest in Tesla, and what I was doing is I was selling at the money calls, which meant that if the price of Tesla was $880, what I would do is I would sell an $882 call, get a $2 appreciation plus $3,000 of cash that they would pay me for selling that option. The only problem is the last couple of weeks the market fell, and what happened is I ran into this problem called a margin call. And I'm glad I learned this issue early on, but a margin call essentially is if you borrow money and your share price go below a certain point, you have to pay that back. So I was right on that line where I needed to pay the money back, so I would have to sold my shares for less money than what I paid. So margin is a tool that either could enhance your gains, but also could enhance your losses as well. And because Tesla was riding up, I thought it would have been a great idea to borrow some money and then sell covered calls at the money and keep rinsing and repeating for a weekly income of $2,000. And that's what was going on for a couple weeks until the market started tanking, or at least there was a correction and I couldn't necessarily continue that strategy. So what I needed to do is I needed some cash. So what I did is I was selling calls earlier. I bought those calls back and I set the time for 2 years because again, I'm a long-term investor. I'm going to hang on to this for some time. And someone decided to pay me $14,750 per share to do this. So since I sold two, a total gain of $29,000. And with this $29,000, it reduced my margin, which allowed me to keep all my shares. And then eventually this last week, Tesla has appreciated. So, it kind of worked out behind it is, so I set the expiration date of March 17, 2023. So ideally, I believe that Tesla had a huge run up, and I'm very appreciative of it. It allowed me to make an immense amount of money, but that's paper gains. I technically haven't sold out, so I haven't made any money yet. But, pretty much, it was going up. And what I decided at what point I wanted to sell the calls at. So pretty much stock price is this. So, it had a huge appreciation. And I think Tesla's going to trade pretty stagnantly next year until we have some big news like developing full self-driving or it's fully released, or that, they're hitting million production and semi, or, what I mean? So there's a couple catalysts that are brewing right now, or the energy that, if they are released, this will cause the stock price to go higher. But I think from now until the end of this year, it's just execution. They need to be executing on their promises. So in that sense, I think the stock will be pretty stagnant. Do I think it'll be over $1,000? Probably, but I don't think it'll be past $13.75. So I decided that $13.75 was going to be the price that I would be okay selling my shares. So pretty much all I really did is I pressed on this, continued, and then pretty much since I own the 200 shares, the shares executed and someone paid me the $29,000 here to buy these shares. So pretty much that's as simple as it was. If you own the shares, you know, you do some due diligence, you decide what you're okay selling it at, then guess what? You know what? You can get paid that much money too. Now let's talk about the plan if, say, Tesla starts blowing up again and the price goes to $2,000. Well, if that's the case, instead of selling a call, I'll probably buy that back in, because again, I want to keep the shares, so I would have to pay whatever premium it is and then roll it out later on. But pretty much, I just, you know, it's correct. Someone paid me $29,000 to hold on to Tesla, and you know, it's pretty much that simple. So all it really is. So let's get this out of here. So nothing to it. You know, Robinhood makes it simple. I use Fidelity and Robinhood, so you can use whatever broker. All right, I made $29,000. What are the possible outcomes for this option trade? So pretty much the first option is I set my strike price for $13.75. My cost basis for all 300 of my Tesla shares is about $608. So pretty much from $608 to $13.75, this is profit between here, okay? So if I have to sell at $13.75, whatever profit I make from here to here, I retain, plus the $29,000 that other investor paid me to hold on to the Tesla shares. So I make whatever profit from here on top of holding on to the income. Kind of the thing where you miss out doing covered calls is, for example, say the share price is $2,000, but you only set it for $13.75. Well, pretty much you lose a opportunity cost from $13.75 to $2,000, but you don't necessarily actually lose money because you set the price you wanted to sell it at. So to me, that's not a loss to me. But for some people that is, and some people can't handle that, but you know, to each their own. So first option, $13.75. The share price is above $13.75. So pretty much, again, this person paid you $29,000 to buy at $13.75. So the first option is you have to sell your shares. They get assigned, and you have to sell your shares, which again is okay because you already made your profit from $608 to $13.75, plus you got the $29,000. The second option that happens is, and this is the option that I want to happen. So I set my strike price for $13.75, and the stock price is actually lower than that. So in 2 years, in March 17, 2023, ideally I want the share price of the stock to be about $1,200 or $1,300, because my share price, the strike price I want to sell is at $13.75. So if it's below that, not only do I keep my shares, I get to keep that $29,000 premium. And that premium gets paid out right away. So anytime you do an option trade, your premium gets paid out right away. Now there's a third option that I'm thinking about with this trade. So it kind of ties in with the first option, but it kind of puts a little twist on it. So say you want to, you're selling at $13.75, the share price is at $2,000. What you can do is you can actually buy these two contracts back, so you don't have to sell your shares, and then now you unlock your collateral, and then you can do what you want with your shares. Ideally, I don't want to pay $29,000 for that. Ideally, I wait out the next year or 2 years, and if the share price is closer to that, then what I would like it to be kind of closer to the money and end up paying like maybe $2,000 a contract, which since I have two, it would cost me $4,000 to buy these back, and I own my shares. So that is the third option. You could buy these contracts back so that, you can do whatever you want. So then again, you could recoup this gain as well. So you had a couple different options with that. So these are kind of the three outcomes for this trade. Now, everything I do, whether it's growth investing, dividend investing, or this options investing, all it is designed to be like a long-term investor. My goal is to be a long-term investor, and pretty much by doing these option strategies or selling these covered calls, what I want to do is I want to enhance being a long-term investor. Long-term investing has produced the most winners in the stock market. Most of these day traders, like 99% of them, don't make money. The key is to find great companies and to be long-term in those companies. With these options strategies, especially selling covered calls, is what you're doing is pretty much like you are lowering your cost basis, or you're producing income so you can put more money into these great companies. And then, once you own enough of these companies, you can just actually live off of this income, so that's kind of the plan going forward. So it's pretty simple to put these trades in. Pretty much next week I'll show you the covered calls that I will do in my Fidelity account with my Tesla, as well as in my Robinhood account with Palantir. So if you like any of the content, please like, comment, and subscribe. It would really mean a lot to me. And you guys have a great day.